Hi, everyone. I'm Ella Lang, co-host of the Dollars with Cents radio show and podcast, and I'm here with my fellow financial guru, Terence Woude.
Hello, Ella. Hello, everyone. Thanks for joining in. Comprehensive financial planning is our passion, and helping people grow and protect their wealth is our mission. Contributing to your RRSP, or your Registered Retirement Savings Plan, is one of the most beneficial and efficient ways to both save for retirement and reduce your annual taxes.
So, as you may already know, all of January and February, we will be dedicating our talks around the best ways to use your RRSP, as it is the season to contribute in order to reduce your taxes and build your retirement nest egg. Now, this week's topic is around RRSP contributions. Should you dump or trickle your dollars? Terence, what am I talking about?
Well, I don't know. What are you? No, I'm kidding. When many Canadians wait until the RRSP deadline each year to make their annual contributions, but they may be leaving the possibility of increased investment returns on the table. There really is a tangible benefit to making RRSP contributions early. So investing annually on January 1st can be a significant difference, but if your budget won't allow for it, consider the value of monthly contributions. So for this example, Ella, let's just say that you're making around $75,000 a year gross, and you decided to dump a $10,000 contribution for the year towards your RRSPs. So here are three scenarios. Okay. Investing $10,000 by the March 1st deadline, which is the majority of the population tends to do that, right? I don't know if your experience is like that, but it certainly is with some of my clients.
Same thing. No, a lot of people do end up doing that because they get their bonus paid out if they've been smart and haven't totally spent it in their holiday season. There is a chunk to give before that March 1st deadline. You're right. A lot of people do that.
Yeah, and so that's the one scenario that we're going to paint, which will be coming up on your screen shortly. The second one is having a monthly contribution. So you have $10,000 that every month you're going to, let's do the calculations on that.
833, something around that.
830, yeah, nicely done. She's a whiz. No calculator. Oh, it's written down there. So $833 per month equals to a $10,000 contribution over 12 months. And then the third scenario is if everything was put in January 1st for the year that you're being taxed. So, for instance, January 1st, 2017 would count towards 2017's taxes. So those are the three scenarios, and you can see that looking at the chart, just below, before we get into the details of the returns, we're going to look at what the assumptions are, which means that you're taking $10,000 contribution and investing it either January 1st, March 1st the following year, or i.e. 14 months later, and it's earning 6% over 20 years, or a monthly contribution of $833, earning 6% over 20 years. So looking at those numbers, as you can see, the March 1st one is the least desired because its return after 20 years is about $370,000. If you contribute monthly, again, $833 for 20 years, it will compound to $385,000. But if you do a lump sum, a dump of the full amount at the beginning of the year, you can see you've hit almost $400,000. So it's $25,000 more. And one may say, well, $25,000 isn't that much over 20 years, is it? I would beg to ask the question, how much is $25,000 worth to you when you're retired? What's your cost of living when you're retired, and how much is $25,000? I would gather to say that that's probably a half a year of your retirement, right? So it's worth quite a bit.
Let's recap all those numbers. So I have $10,000 that I'm going to put into my RRSPs by the deadline, which for this year, folks, is March 1st, 2017. And I'm going to do that every year for 20 years because that would be making it so that I'm putting $200,000 of my money into an RRSP that will grow at a rate of 6% per year or on average, which is a reasonable rate of return with investments that, would you agree, Terence, are moderate?
Definitely a moderate, almost bordering on moderate conservative. Moderate to moderate aggressive would be looking more at around 7% or so.
Very good. And that will grow, as we saw, to just over $370,000. So that means I receive $170,000 worth of growth. Wow.
Now let's take a look at that. Actually, that was a really good question around the moderate risk versus the moderate aggressive risk. Mm-hmm. So these are the projections at 6%. Mm-hmm. So let's just for fun, let's take the January 1st number, mm-hmm. and we'll calculate it at 7%. We're just going to go into the calculator here.
Works out to $438,650, Terence.
Wow, you are like the human calculator. Man, that was quick. A great financial planner, by the way, folks, will be able to do that for you. Those calculations are easily doable in front of people.
Terence, very proud to say that. We're using our financial calculator to make those phenomenal calculations, folks. So.
Yes, but we're the only ones that know how to use it. Anyway, so again, a 7% rate of return will give you how much more than what's predicted at a 6% rate? 395,000 was a 6% rate, and this would be almost 439,000. So we're talking almost $43,000 difference by that 1%.
For that amount of time, 1% makes a difference over 20 years of nearly $43,000. Wow.
That's a lot of retirement. So anyways, those are the three scenarios there that sort of paint the picture of what it will be like. And obviously the best is to put a lump sum at the beginning. That will always be able to give you more money, make your money grow better. And very simply, it's because it has the time. Time is the only factor. Well, not the only factor, but a really, really strong factor when it comes to exponential growth. The more time you have to grow, the better it is. That's why those younger ones who are listening right now, those who are in your 20s, you have an incredibly unique opportunity to save for your retirement and spend way less than anybody else that's my age in the mid-40s for their retirement. It's going to cost me so much more to get the same amount of money for my 65th birthday than what it would cost you if you're between the ages of 20 and 30.
That's a great point, Terence. And just to point out that not everyone has that lump sum available after the holiday season, as I mentioned. You may have bought lots of gifts or what have you, but not everyone needs to dump a lump sum. You can do monthly contributions. Remember, if that fits into your cash flow, your monthly budget, well, check it out. It might make that world of a difference in the future, as we've just pointed out.
So as per usual with our YouTube channel, that you'll be able to see these projections on the screen in front of you. They're also available on our Facebook page. Look at it through there and then be able to leave us a comment. I know I'm more of a visual person who needs to see the numbers in front of me to really comprehend the concept. So if you are not able to see it in front of the screen right now for whatever reason, make sure you go back and take a look if you're feeling like you don't quite understand it.
Now, what happens, Terence, if for a reason or another I have decided to contribute regularly, but we've decided to buy a house now and we're going to pull all our funds together and we're going to maybe stop our payments for a year, or I suffer a disability, for example, and, well, I'm not going to be bringing in, let's say, 20%. If my insurance hopefully covers 80% of my income, well, that 20% might just have to wait for a while. I'm going to stop paying into my RRSP for a year. What happens?
That's a great question, and it can be as simple as that. The costs of having a child are a lot more than you can than you can handle, and the RRSP contribution has to be sacrificed because of it. That happens to a lot of people all the time. So this is an exercise that's for the millennials out there. Again, Ella and I are going to use our imagination to throw us back to being those millennials. Me being the hipster and Ella being dashing. So Ella contributes every year, but me, I take a break as a hipster. I gotta go see the world, right? I gotta go experience a few things. So I use my money to go travel to Australia, which I did do when I was a youth. It was a great experience. I would recommend it to any 19-year-old because I think that's how old I was when I went. The next year, I decided to buy a car and pay for it for the next 3 years. Then I decided to go back to my original plan of contributing to my RSP. Now, let's fast forward to 65 years. So let's take a look at the chart that's in front of you now. Let me just explain the chart quickly. It's called Contribute Early and Contribute Regularly. Time is precious, obviously. That's what the discussion part of it is. So basically what this shows is the starting age at 25, total contributions of the 25-year-old is $200,000 and invested at 6%. Let's actually scroll down further on the page and we'll go through the assumptions again. So this means a $5,000 annual investment, which is how much per month?
$416.
Wow, she is so quick. It's amazing. It's so cool. Anyways, so the assumption is $5,000 annual investment that is compounded at 6%, again, the moderate rate of return, annually. And all accumulations are before there's any taxes. Now, you may be saying, well, it's RRSPs. We have to put that down, folks. We have to say that everything is accumulated before tax. It's part of our regulations. So, putting your eyes back up to the table, you'll see that starting at age 25, total contributions are $200,000, and the plan of the value at 65, $773,000, and lost by delaying because our starting age is 25. There is no loss because they contributed $200,000 by doing $5,000 a year. For how many years? So from age 25 to age 65 for 40 years, $5,000 a year will give you $873,000 at age 25. Now, the point of this is if you do it 1 year later, and stop contributing at 65, you'll have a total contribution of $195,000, and you'll have lost $48,000 because of that delay. That $5,000 that you did not put in actually cost your future self almost 10 times the amount. And then it keeps going if you keep delaying, right? And you go down to age 29, you've only got $180,000 contributed because that's me, right? Ella started at age 25 and didn't go to Australia and put 5,000. I did my thing, went to Australia and came back, and then I started at age 29. And now we're 65 years old, and Ella and I are going, wow, that was quite the ride, our working careers. And now we're both retired. And how much money did you got, Ella? How much money did you have saved up? And she's got $774,000. Me? I've got $170,000 less. Because I waited, that $20,000 less that I contributed and waited till later on cost me $170,000.
Even a short postponement of 4 years can result in more than $200,000 of lost value. That's what that chart is really important, and it really is quite clear to show everybody. Time is on your side, so you simply have to use it to your advantage, millennials, and make smart decisions earlier rather than later. If I could go back in time, oh my, would I be changing some of my habits, I'll tell you right now. But there you are. At least I can push that on my son, and hopefully he makes better decisions.
It was once said to me, and I think it's very wise, you make the decisions you made with the knowledge you had at the time.
That's right.
So no use crying over spilled milk. I think that's another way to phrase it up. So, anyways, this really shows, especially at a millennium example, but even if you're 40 and you've got 20 years of retirement, the exponential growth is still quite powerful. Again, at the 6% or 7% rate, you can use the rule of 72. We talked about that a little bit last week's episode, so refer back to that one. But essentially, that means if you gain a 7% return on your money, it doubles every decade. So now we're coming up to call to action, the action item that we have for you today, which an important part of making sure that your RSP contributions can happen on a regular basis, that you can afford it, that that your money isn't going elsewhere that you're not aware of, is through tracking your cash flow. And a lot of people find this very difficult because because one has to put some work into it. Your action item today is to reach out to us for what's coming up on your screen now. We have a cash flow analysis sheet that is an Excel spreadsheet that you'll be able to use and monitor what your monthly expenses are. And it's a very useful tool. I use it for all my clients, and Ella and I would like to be able to give it to you at no cost. All you need to do is reach out to us either by phone or by email, or leave us a message on either Facebook or on the YouTube channel, which we'll get into at the end about exactly how to get a hold of us. Make sure that you reach out to us if this is something you want.
So why is this cash flow analysis important? Well, folks, if you have no idea where your expenses are going each month, then this is one way of tracking it. Get yourself an envelope, put down expenses for the month, write down January, February, March, April, May, June, July in different envelopes if you have to, and keep every single receipt. You go for a coffee at Starbucks, you pick up some donuts at Tim Ho's, whatever it is, make sure even your gas bill, you're paying receipts for kids' toys, whatever happens, you throw that, empty out your wallets and put it into your envelope and track it. And then go refer to your worksheet. You can absolutely see where your money goes. Another way of tracking this is through your bank statements. Each month you'll see where your money's gone, because it is exactly, if you pay by debit, I know I do, I try to use my credit card unless I'm buying gas or a big purchase, I don't use my credit card. You can go back and check your statements, and that will be an absolute detail of where you are spending your money. And this will help identify what uncommitted funds are left over each month so that you can dedicate an amount to an RRSP contribution, monthly contribution. And we've explained why that's important.
Yeah, that is a great, the envelope idea is really awesome. Using debit is a great way to make sure that you don't abuse the credit side of things. For me and my household, I've done this for many years, probably 15 years now. I use a credit card for every single purchase, but I do that with the absolute law and rule that after 30 days it gets paid to zero. I've not paid interest on my credit card that I use daily in a very long time. If you're able to have that discipline to be able to do that, then what happens is you can track all of your expenses onto one statement. It'll be one credit card that makes it possible to do so. And the further reason as to why I do that is because there's a free accounting software called mint.com, mint.com, that I use, and I have used on 7 years now, where it tracks every single, it's a bookkeeper. It's basically my bookkeeper, and I'm sorry to, I hope I don't offend any bookkeepers out there, but what happens is that when I do a transaction, when I buy something at the store, let's say I go to Costco and I buy groceries at Costco, then what happens is that Costco purchase gets automatically categorized to my grocery spending, and then that comes up on the software, and it all happens while in the background. So I am now spending maybe an hour a month on tracking my expenses, because it gives me all the details of spreadsheets and budgets, etc. So mint.com is one that I would recommend if you're into that kind of thing. It also tracks others like your debit card and everything as well. So any electronic transaction can be tracked by mint.com. It's safe, it's secure, it has the same kind of encryption code that the banks do. The only thing about it that makes some people uncomfortable is it's cloud technology. So it's your technology is held out somewhere probably in the middle of the States or something like that.
Maybe Putin might be watching my expenses, Terence?
I kind of doubt that because yes, he's got over 300. If he's monitoring Canada as well, he's got over 330 million people to go through. So, yes, he probably doesn't, right?
So there you go, folks. That's another fantastic episode of Dollars with Sense. If you have any questions, certainly comments are always very welcome. Reach out to us. You can write us on Facebook, Dollars with Sense. That's our page. And that's where we'll be posting our shows. Certainly, you can also reach out to us on our YouTube channel. If you punch in Ella and Terence, YouTube search bar, you can find Ella and Terence. Our channel pops up there, and we invite you to subscribe so that you'll know when a new episode is up and loaded and ready to go, where you can also access our other 40 episodes or 39 episodes.
Soon to be 40.
Soon to be 40 episodes. Thank you very much, Terence. And definitely check out what we have available for you. You can write to us by email. That's at 2financialgurus@gmail.com. That's the number 2 financialgurus@gmail.com. And you know that we'd love to hear from you by telephone. Here's one number for you. You guys should never forget. It's 778-879-0820.
Thank you, Ella. That's great. Remember to reach out for us if you want to have the cash flow analysis Excel spreadsheet emailed to you. Just let us know, and we'll send it off, and then we can help you navigate it if you like as well. Just let us know. Please tune in for next week. We're going to have our next episode around using your money more wisely when it comes to how much you give to the federal government. We call it giving yourself a raise, so that's keeping more money in your jeans rather than putting it through payroll tax to the government. We also like to say thank you to everybody else at 98.7 The Point who puts us on their radio show every Sunday morning at 8 a.m. We are grateful to them for helping us establish this great show, the Dollars with Sense. So I'm Terence Woude.
And I'm Ella Lang.
And we're your financial gurus here on Dollars with Sense. Have yourself a great week ahead, and
may your dollars and cents be with you.
This podcast is presented as a general source of information only and is not intended as a solicitation to buy or sell specific investments, nor is it intended to provide professional advice, including without limitation investment, financial, legal, accounting, or tax advice. For more information on this topic or any other investment or financial matters, please contact an Investors Group consultant. Prospective investors should review the annual report, simplified prospectus, and annual information form of any fund carefully before making an investment decision. Clients should discuss their situation with their consultants for advice based on their specific circumstances. Commissions, fees, and expenses may be associated with mutual fund investments and the use of Symphony Strategic Investment Planning. Read the prospectus and speak to an Investors Group consultant before investing. Mutual funds are not guaranteed, values change frequently, and past performance may not be repeated. Symphony is an asset allocation service which provides a strategic approach to investment planning relating only to Investors Group mutual funds. Trademarks, including Investors Group, are owned by IGM Financial Incorporation and licensed to its subsidiary corporations.